Titan's Q3 earnings have surpassed all estimates, aided by higher jewelry sales. This segment continues to sparkle, posting more than 30% growth. But raw material costs went up more than 60%, and margins continue to remain under pressure. Nishant Sharma had a chat with the Managing Director, Mr. Bhaskar Bhat, and began by asking if the strong growth rate can be sustained in FY20. Listen in.
Well, we had a poor growth in Q1, if you remember. So the first half was a little subdued because of that. However, we did expect a surge in Q3, and we had planned as well a lot of activation, a lot of new product launches, and it's worked for us. So we made up a lot of the lost sales in a way by way of our targets. That kind of growth, of course, is difficult because, Dhanteras is sitting in the middle of that festive season.
Right.
But the wedding season is continuing, and we should be able to achieve our goals, which we had earlier talked about. We had talked about a 25% growth in jewelry, and our target is still to achieve that for Q4, and overall at about 23%.
Right. And your margins have come off a little bit for the second straight quarter. Where do you see the pressure?
Margins have come off?
A little bit. Not.
Well, it's we had very healthy margin in the watch business for the first 6 months, but it was not sustainable at 18% odd. So the watch business had rescheduled its advertising to Q3, and a few other costs as well. So the watch division PBT dropped in Q3, and it's now averaging at 15%. So that is one of the reasons why. The other reason, of course, is we have provided for another 70 crores for the ILFS. Yeah. So there is no fundamental change in the health. It was a very good performance in the first 6 months from the PBT side, but otherwise the health of the company continues to be good. All divisions are doing well.
Mm-hmm. And talking about the ILFS exposure, last quarter 29 crores you saw provision. This quarter you saw 70 crore. Can you give me any further cues with regards to provisioning that you can offer?
Well, this is the right provisioning. It's based on our assessment of what needs to be done based on information available, and that's enough for now. What we need to do, if at all, we'll figure out in Q4.
Right. And talking about the watches segment, can you give me a split in terms of where you're getting the revenue from? How much of the revenue you're getting from the mass segment or that from the premium brand?
In fact, this year has gone well for brand Titan. Is growing extremely well, and that is also our most profitable brand. Also, one of the reasons for the dip in the margin in Q3 has been an extraordinary growth in the e-commerce channels, the marketplaces, which do their big billion day and so on. And those are basically lower priced watches that sell, primarily Fast Track and Sonata. And the proportion of these brands in the total sale has gone up in Q3, and that has also impacted margins. But for the year, the health of the business continues to be good. This is thanks to the recrafting that the business undertook a couple of years back, and it's playing out well. In fact, the new product introductions have done extremely well. The Raga I Am campaign, and then the Reflex, Fast Track Reflex Wave watch that we launched, band, is doing extremely well. So all the new products we've launched are doing well. We've had Grandmaster and Titan. So overall,
right,
the sales is good.
And how is the smartwatches category also doing? Can you give me more color on that?
We have if I were to take the combination smart and wearables, our performance has improved considerably. We have become quite a significant player in the Indian market, and we will continue. In every brand now we have a smartwatch, Sonata, Fast Track, Titan, women's watches. That will only grow. And you will see innovations coming from Titan in that area. Of course, that's a very potential category. So I think we are in a good space. We have the regular analog watches and the smart watches, and both have their customers. This one, of course, is growing much faster. So the new age watches and channels are the ones which are growing much faster than the traditional channels and watches. But the traditional watches are also coming back in a way.
Right. So, do you think that the new age watches will play a bigger, larger role in terms of driving revenues going forward? And when do you see a larger pie of that coming from?
Certainly growing, and over the next 3 to 5 years, it will become much bigger, because the traditional analog watches, the rate of growth could be 5 to 7%, whereas these will be in excess of 25-30%. So the proportion will change. The challenge will be, so the volume gain is what we are looking at, and in our watch business, as you gain in volume and scale, the profitability goes up manyfold. Mm-hmm. So that's the good news in the watch business.
But the competition is also higher in the smartwatches category.
Well, with our distribution strength and our brand strength, we are already ahead of many of the small competitors. If you're talking of the Apple and Samsung, they are another category league already, altogether. And yes, they are competition, but we look at this movement as an opportunity, because it has expanded the wristwear, category, and the need to get something onto your wrist, whether it's a health tracker or a fitness band or a traditional watch or a mechanical or quartz. It's good news for the watch business, for the watch industry, in fact.
Right. And also, what is your e-commerce strategy looks like?
E-commerce differs from business to business. If you take the watch business, it's on our own site, as well as we are on the marketplaces. Eyewear is very unique. We do a lot of innovation in eyewear through our partnership with CaratLane. And in jewelry, CaratLane is the larger e-commerce brand. Tanishq is primarily its own site. So it depends on the kind of customer that you have, because jewelry, at least the kind like Tanishq and Zoya, are brick and mortar brands.
Right. And talking about the eyewear segment, the losses have narrowed. At one point in time, you expect to see profits coming consistently.
So our strategy of scaling up, we have set for ourselves a goal by 2023 of touching 10 million customers per annum in this business, and that target we are well on our way achieving. And this year's volume growth is a big turnaround. We were doing 1-2% same store growth. Now we are at 12% same store growth, and total growth of 27%. So it is through entering newer price points without losing out on margin, but at the same time correcting the price perception. See, there is a fair amount of growth in this industry, but the kind of quality that is being offered by some of the very low-end players is suspect, and that's not good for the industry, because it is about your eyes and vision. And we have stayed the course, wanting to offer a very good solution for your vision. At the same time, we've now started distributing our frames. We started manufacturing frames, and we've got a large number of satellite lens labs now to be able to give quick delivery of lenses to customers. So it's a journey we are very confident of. It's a very underserved market and can only grow.
And you mentioned about, offering low price point products in the eyewear category as well. What's on that?
We've already offered. We are still seen as a higher price player, premium player, but that is because a lot of the so-called mom and pop stores who don't have properly trained optometrists and who at least earlier were not paying taxes in a way. There is a lot of unorganized in this, and they were able to offer low prices.
Right.
We, through our now manufacturing of our own frames and smart sourcing and our own designs, are now able to, and because of the volumes, we are able to get better prices. So it's a new price point, not a drop in price.
Talking about the innovation, you mentioned, we spoke about the smartwatches category as well, how you're also innovating. And what kind of push is there as far as the innovation is concerned, as far as, Titan?
Well, Titan, push on innovation is no longer specific. The company has been, in some way, fortunate enough to have an innovation culture. So it is primarily in product, and you are seeing a lot of innovative products being launched all the time. In smart, if you see, it is more, we are a late entrant in that category, but the way the wave, gesture band has worked, and that's, we have the slimmest in that category. So those are innovations. Apart from that, there are continuous innovations in customer experience in the store, in the manner in which we woo customers through analytics we now have a separate digital team. So it is across the board. I can't pinpoint one big innovation like the Edge or something today. It's become a part of our DNA, if you say.
Right, and just one more bit. How do you see the contribution of the revenue coming from watches and eyewear segment going forward?
Well, watches has come back to growth in the double-digit space. Eyewear, of course, is, as I said, is at 20+%, 27% combined, same store, and total is 27%. So we do expect to grow at that rate. Next year's targets are different, but this year we will achieve that growth rate.